So are we in a recession? Well, prices have started to cool off for the first time in a really, really long time. We are now seeing a shift in the real estate market and actually the overall economy. The media has been hyping this up even more because some home buyers have been pushed away and are shying away from the market even. This is exactly why we need to dig deep and get into the data to get the real story. And more importantly, to see if there are opportunities that exist or are coming for us. Today, I'm going to talk about three things. Will home prices even fall more, and by how much? What are the risks to keep an eye out for? And what should we do if you're a buyer or an investor looking for opportunities right now? Now, that last part is going to be super important, so make sure you stick around. When you talk about opportunities in the real estate market, it's important to look at what rich people are doing with their money. Just a couple of months ago, Blackstone, one of the largest investment firms in the entire country, just raised one of their largest real estate funds for the sole purpose of buying more real estate this coming year. They've been buying real estate all along, but they're about to double down. And now, like I said earlier, the media is overhyping this because of the fear is what drives the news. For example, in a recent story that home prices had their biggest decline since 2011, if you actually read more, the decline was actually less than 1%, with home prices up nearly 20% in the last year. A decline of 1% is hardly a cause for concern. What this means is home prices are going to go sideways for a while. And in certain markets, they're even going to slightly decline before they go back up again. Now, you're seeing a crash in listing prices. There have been more price cuts in the last 3 months than there have been in any quarter before. That's because sellers and listing agents always seem to be caught off guard when the market shifts. And they are so naive that they're pricing homes as if none of this is happening. So the big question is this: how much will real estate prices fall? The answer is a little bit less dramatic. And what the media is telling you, it's not really accurate. Now, the important to note thing is that the strong asset class that's up a lot is gonna have to pull back. This is actually very normal for a healthy market and for a long term. On a national basis, the data firm CoreLogic is predicting that home prices will basically go sideways. They're going to be slightly up when you look at the numbers year over year, but this assessment is based on a national basis. So each market's going to be a little bit different. So if you're in a hot market that spikes super fast, you can see prices slightly decline sooner rather than later. After personally reading hundreds of reports on this topic, I'm going to predict that home prices in those high growth markets are going to pull back about 10% from where they are at just today. And this is going to happen over the next 12 to 24 months. Now, there's one major risk to keep an eye on, which I'm going to get into just in a few minutes. But as of right now, given the current data, that's the most probable, it's important to know that in high growth markets, what really caused these prices to spike was low supply, cheap money, and high demand. The demand for growth is due to population and job growth and the desire to live in a certain area. You know, as of today, cheap money has been taken away, which has really cooled off the market and the buyer demand. But other factors still exist. And remember, when you're looking at these declines, you have to look at the final closed sales price, not the price that the seller or the listing agent or even a builder put it on the market for and is asking. Another reason why you're seeing demand plunge is the recession fear. Now, this is because it drives young home buyers' decisions. When you get one of these inflection points, many become scared and confused. Confusion causes many buyers to go to the sidelines, initially, which is why you see such a sharp decline, but over time, this seems to normalize. Many of these young home buyers fear that home prices are going to crash like they did in 2008. They also feel that the market is due for a sharp pullback because home prices are up so much. But from 2018 to 2022, the National Home Price Index was up over 43%. And in certain growth markets, home prices were up even more. Like here in California, home prices were up over that same 4-year period, over 60%. And a big chunk of those gains happened in 2021 and 2022. The crazy run that again fueled by super cheap money and low supply of homes available for sale. Now, many people feel that this created another housing bubble, but I think you'll be surprised when we actually look at the characteristics of today's market versus 2008. When you think about a housing bubble, it's mostly fueled by debt, meaning people are taking on way too much debt to buy property. This is called leverage. And in years leading up to the last housing crisis, there was way too much leverage. People weren't putting very much money down when they bought a property, and they were using their homes like ATMs. Another key factor for a bubble is extreme speculation. This means that people are buying the asset with the sole purpose of making quick, fast money. Back before 2008, real estate has been kind of, or at least seen as a get-rich-quick scheme versus the buyers of today looking at holding the property for the long term. It's important to note that on the debt side today, Americans are actually sitting on a record amount of home equity. The majority of homeowners in this country right now currently have more than 20% equity in their homes, and there's only a small fraction of homeowners that don't have any equity in their house. Back in 2008, homeowners had very little equity, and when prices pulled back just a little bit, they were quickly upside down in their properties. This is what fueled foreclosure activity. And if you look at the current data, foreclosures are at a multi-year low. That's because even if you go into default on your loan, you can simply sell the property if you have some equity in it. That's the main reason why somebody would walk away from a property, is if they don't have any equity in it. Even if you can't afford your payments, you can still today hire an agent and sell that property, and it would be better than walking away, and it would actually have you avoid foreclosure. So based on the fact there's this small amount of equity out there, even if home prices still pull back, you're not going to see a wave of foreclosures like we saw back then. Another assumption is that people have, when they see inflated stocks crash or cryptocurrency crash, they think that, well, the real estate market is next. But when you look at the differences between assets today, it's pretty clear that real estate doesn't trade like that. Now, there's a general premise when people buy a home that's going to go up in value over the long run, but that's not the sole reason they're buying it. There's a real kind of utility in owning a home in a neighborhood that a family wants to live in. There's advantages to owning rental properties for a long term. Real estate is not the same as a get-rich-quick scheme that you're seeing these pump and dump investments like stocks and crypto. Another important factor, the current market and compared to 2008, is that mortgage lending standards in today's market are still dramatically different. It is difficult to get a mortgage today as compared to 2008. Before the market crashed, if you look at the Mortgage Credit Availability Index, lending standards back then were so loose, basically anybody and everybody could get a loan. Today, you have to actually qualify, and you have to prove you have the ability to repay these loans. This is just another factor that would prevent mass foreclosures from happening. Now, the last thing to note is that this section is the supply issue. If you look at the chart of the number of single-family homes being built in this country, you'll see that after the crash of 2008, the number of homes being built went down significantly. This figure has been well known below a 50-year average for the past 14 years. What this means is we haven't been able to build enough homes to meet the demands of the country. There are so many millennials who are forming households today, and these millennials are at the peak of their home buying years. So regardless of what happens with the economy, there simply aren't enough single-family homes to meet the needs of all the people who want to live in them. This is important to consider when you think about what's going to happen with home prices over the next coming years. Now, before we get into the opportunities I'm seeing, let's get into one risk factor that could change all of these predictions. As I said earlier, the main reason for decline in demand was that money became more expensive. Interest rates for home loans went up, and they went up really, really fast. We've seen interest rates go from 3% to 7% in the past 8 months. Now, keep in mind, when these rates were at the low threes, that was just way too low. And that was just more of an anomaly based on what the Fed was doing at the time. But even so, a move from 3 to 7% in such a short period of time is totally unprecedented, and this will take some time for buyers to adjust to the new rates. As of the recording of this video, mortgage rates are hovering in the mid sevens, and that's the upper end of the range that we've been over the past few months. But if we were going to go much higher than where they're at today, this presents a real risk to the housing market. The reason is most home buyers finance the majority of their home purchase. So in that case, they're really buying the monthly payment of the property, not just the price of the property. The higher that these rates go, the monthly payments also move, and less buyers are able to actually spend monthly. If the rates stay at the current range, then these predictions will remain about the same. The buyers will adjust to the new normal. But if you see rates spike towards 8% or higher, that would be a cause for concern. And my prediction for home prices will get worse as well. Most experts don't predict that they're going to go that much higher, but I just want you to know, because this is a single most important factor in the housing market. Also, keep in mind that mortgage rates move with inflation. So when the Fed is eventually able to get these inflation numbers down, you should see mortgage rates cool off as well. As we've shifted into a buyer's market, you're going to see opportunities. There's many sellers who've listed their properties for way too much money. The property needs some updating, and now the listing is sitting on the market for a long time and it becomes stale. Now, a year ago, you could list a property in any condition and you would get 10 offers, but that's not the case today. Today, you actually have to have a good product. You have to price it properly, and that's hard for a seller and a listing agent to do. On some of these stale listings, you're gonna have an opportunity to get the property well under the asking price or with concessions from a seller. Now, what are concessions? Well, a concession is a credit or a give back from the seller to a buyer, and you can work this into your deal. For example, you can get a seller to pay a credit and buy down your interest rate, which makes your monthly payment lower on the property. And then keep in mind, when mortgage rates come down in the future, you'll be able to reduce your interest rate and your monthly payment. Now, nobody can predict exactly when mortgage rates will come down, but there's going to be an opportunity in the coming years. Fannie Mae even recently came up with an article that said interest rates are going to cool off in the mid-4s within the next year or so. So using that data, the game plan would be to use the current environment and get a much better deal on a property and go ahead and take the current interest rate and keep an eye on rates in the future. Because when these rates pull back, you'll be able to reduce your rate and your monthly payment on that original debt. Now, there's also some other opportunities in the market where you could get a better deal on a property and take over the seller's current financing. It might lead to a much lower rate compared to today's rates. This means that you can get the best of both worlds, actually. You get the pullback in price, you also get cheap money, which was available a year or two ago. Now, these opportunities are a little bit harder to find, but they do exist. I'm gonna actually make another video on that specific topic, and I'll have that coming out soon. Another opportunity that you're gonna have in today's market is to structure a better deal with these dated properties. Many properties that you look at today are gonna need some level of upgrading. With the current negotiating power, you can structure some of these repairs into a deal. You can get a credit from the seller that could cover all of your closing costs, and then you could turn around and use those funds that you would have had to normally pay towards those closing costs. Instead, use them for new carpet, new kitchen upgrades, or anything that's needed to make the property up to the current standard. Now, if you even need a larger credit, what you can do is you can structure certain repairs to be paid by the seller either during the transaction or at the closing. This gets a little bit more complex, so definitely you want to work with a real estate agent and a lender and know how to structure that deal correctly. But basically, what you would do is you would put the cost of the repairs or the remodel into the deal. So the funds needed to pay the contractors would be withheld from the seller's proceeds at closing, and then those funds would be dispersed to make those repairs. Just a few months ago, trying to build this type of repair allowance into a deal, it would honestly be absolutely impossible. But now you can definitely do this on the right deal. Now, keep in mind, your ability to negotiate and work out one of these deals with a seller is gonna depend on each specific deal and each specific market. Every deal is gonna be a little bit different. Another thing that's really important to understand is that smart investors make the most money betting on what's most likely to happen. Well, what does this mean? So while yes, there is a small risk, a very small risk that things get out of control and the whole market and everything goes to hell, but you're not gonna be able to make money on that thesis. See, what's most likely to happen is that something that's way less dramatic based on the data points that we're actually looking at today is gonna happen. I talk to so many wealthy people who are, quote, waiting for the market to crash. And the thing is, the last time it crashed, very few people were waiting for the market to crash. They were in debt up to their ears. They were over leveraged. They weren't prepared for this. And that's the part of the reason why the market crashed, is because people were on the wrong side of the tracks at that time. They're all prepared for this crazy event to happen. That means the crazy event is actually less likely to happen. Now, if you have questions about your specific scenario or what's going on in this market and any opportunities that maybe you could capitalize on this coming year, I put a link in the description down below. Feel free, reach out for more information or simply book a call. I'm going to be watching all of these data points and I will bring them to you and all the information as soon as it becomes available. And until then, I'll see you on the next video.